Usually when we talk about the money in our wallets, there's this expectation of straightforward physics, like a rain barrel.
Right, yeah. You earn a dollar, the water level goes up.
Exactly. You spend a dollar, it goes down, in or out. It's clean, it's simple, visible.
And it's comforting to think of it that way. I mean, we like our personal finances to be visible, categorized in neat little columns, where we can track every single drop.
I think then you step into the world of global macroeconomics, central banking, sovereign wealth, and that simple rain barrel just completely vanishes.
Oh, completely. It's gone.
Right. We're suddenly looking at a financial landscape that is, well, it's a massive hidden plumbing system, a labyrinth of pipes spanning the entire globe.
And what looks like a leak in one pipe is actually a highly engineered pressure valve for another.
Exactly. So today, our mission is to unpack a stack of fascinating economic notes and sources to really reveal the actual alchemy of modern money.
Yeah, we're going to trace the life cycle of a single export dollar.
Right? We'll follow it to see how it creates wealth, how it triggers inflation, how it forces central banks to literally invent money out of thin air.
And ultimately, how it shapes the destiny of entire nations.
And we actually have a perfect catalyst to start this journey. It's a major turning point in modern economic history that was highlighted right at the top of our source material.
Right. So in February 2025, a massive shift occurred when the United States officially launched a federal sovereign wealth fund, or an SWF.
Right. And setting aside all the politics, because we are just looking at the pure mechanics today, this move breaks a very long-standing American tradition.
It really does.
And it serves as our entry point into understanding how countries hoard, hide, and weaponize wealth. So let's look at the historical context first.
Yeah.
Before 2025, the United States actively avoided having a federal, national team for investments. Why was the U.S. so late to this party when countries like Norway or Saudi Arabia have been doing it for decades?
Well, there were three main structural and ideological reasons for that hesitation. First, there was this deeply ingrained preference for market fundamentalism.
Okay.
The prevailing view in Washington for decades was that the government shouldn't act like a hedge fund, right? It shouldn't be picking winners and losers or competing in the market.
Yeah, keep the state out of the stock market.
Exactly. Keep them out of the private sector's allocation of capital. The second reason is tied to the unique, really the apex status of the U.S. dollar.
Oh, so?
Well, when a country like Saudi Arabia exports billions of dollars of oil, they get paid in a foreign currency, U.S. dollars. So they built a massive sovereign wealth fund to absorb all those excess foreign dollars to prevent their own domestic economy from overheating.
I see.
But the U.S. is historically a trade deficit country. It imports more than it exports, and it relies on issuing treasury bonds to attract capital inflows.
Right, so it simply didn't have a massive pile of spare cash from foreign trade that needed to be parked overseas. It was the one borrowing the money, not hoarding it.
Exactly. And the third reason, just simple political gridlock.
Oh, of course.
The idea of the federal government managing a multi-billion or eventually trillion-dollar investment portfolio, I mean, it always faced immense friction. The debates over who controls it, what industries it invests in,
Yeah.
and whether it prioritizes financial returns or political goals, that always stalled it out.
But looking at the notes, while the federal government dragged its feet, individual U.S. states are actually sovereign wealth fund veterans.
Oh, absolutely. They've been doing this for a long time.
The numbers here are staggering. Alaska has the Alaska Permanent Fund, which by 2025 was sitting at around $835 billion, funded mostly by oil and gas royalties.
Yeah, it's a textbook resource fund. They even use it to pay direct annual dividends to their residents.
Right. Then there's Texas. The Texas Permanent School Fund has about $560 billion that's generated from public lands and mineral resources dating back to the 1800s. Yeah, and New Mexico has the State Investment Council Fund at roughly $530 billion. Wyoming has a mineral trust fund of about $126 billion.
Right, so the concept of a government taking resource wealth and throwing it into a giant investment pool is actually deeply American. It just operated at the state level until 2025.
Okay, but the stated purpose of this new federal fund, according to the sources, is to invest in major domestic infrastructure. Things like energy grids, advanced manufacturing, cutting-edge tech.
And to serve as a tool for strategic geopolitical competition, yeah.
Right, but I have to push back on the mechanics of that, though. Reading through the proposed funding models for this new federal SWF, they talk about using tariffs, spending cuts, or asset sales.
Sure.
But the U.S. federal government is already running a massive national deficit. The national debt is well over $30 trillion. So if you are already running a massive deficit, isn't starting a multi-billion-dollar investment fund essentially like taking out a high-interest credit card just so you can play the stock market?
Yeah, that tension right there. Between being heavily in debt but simultaneously launching a massive wealth fund, that perfectly pivots us into one of the most misunderstood macroeconomic paradoxes in the world.
Okay.
It confuses people constantly. How can a country have a broke government but still be incredibly rich?
Because you hear fiscal deficit and you picture a bankrupt nation. But then you hear the same country has a trade surplus and you think they're swimming in gold. Which one is the reality?
Well, they both are. Both are reality, but they exist in completely different buckets.
The different buckets.
Yeah. To understand this contradiction, you have to completely decouple the idea of the state or the country from the government.
Okay, so split them up.
When a country runs a trade surplus, it means they are exporting more goods than they import. But the government isn't the one manufacturing and selling those goods.
Right, the private sector is.
Exactly. It's the citizens, the corporations, the factory owners. So a trade surplus means the private sector is raking in massive amounts of foreign cash.
While the government is simultaneously running a deficit, meaning they are spending more on roads, defense, and Medicare than they are collecting in taxes.
Right.
So the government bucket is leaking, but the private sector bucket is overflowing.
Precisely. And there is an unbreakable macroeconomic rule that balances this out. Imagine the entire economy as just 3 buckets of water. The private sector bucket, the government bucket, and the foreign bucket.
Okay, I'm picturing the 3 buckets.
All the water, meaning the money, has to be in one of those 3 places. So if the foreign bucket is pouring massive amounts of water into your country because of a trade surplus,
Right.
and your government bucket has a hole in it because it's running a deficit, where is all that water pooling up?
Well, it has to be overflowing in the private sector bucket.
Exactly. Mathematically, if a government is broke but exports are booming, the citizens and domestic corporations must be hoarding a mountain of cash. The wealth is hidden in the private sector.
That makes sense.
And the sources actually cite Japan, Germany, and China as classic real-world examples of this.
Well, let's look at Japan. They are famous for having one of the highest government debt-to-GDP ratios in the world.
They do. Their government debt is massive. But Japan is also an absolute export powerhouse with a historically massive trade surplus.
Right.
So while the Japanese government has been borrowing heavily for decades to fund stimulus programs and infrastructure, the Japanese private sector, the corporations and the households, are sitting on oceans of savings.
Wait, so it's basically like a family where the parents' joint checking account is constantly overdrawn. The parents are the government.
Right.
But the kids, the private sector, have millions of dollars stashed under their mattresses from running a highly successful lemonade stand empire across the neighborhood.
I love that analogy, yeah.
So the family as a whole unit is incredibly rich, but the parents' specific account is deeply in the red. So how do the parents pay the mortgage? They just borrow the kids' lemonade money.
That is exactly how the plumbing works. And it explains how governments tap into this hidden wealth without actually going bankrupt. When a country's private sector is flush with cash from a trade surplus, the government doesn't feel broke the way an individual would.
Because they have access to the kids' mattress money. How do they actually access it, though?
Through their borrowing costs. Because domestic capital is so incredibly abundant, because there is so much savings looking for a safe, boring place to park, the government can issue bonds.
And the private sector buys them.
Right, the private sector will eagerly buy them up. Massive supply of savings means the cost to borrow it drops to the floor, so the government can borrow vast sums of money at incredibly low interest rates.
That's wild.
Furthermore, if there was ever a true existential emergency, the government has an enormously wealthy tax base it could tap into. And most importantly, if the country has monetary sovereignty, meaning it controls its own currency, its central bank can manage the liquidity to ensure the government never actually defaults on its own currency.
So a government with a massive deficit and a country with a massive trade surplus isn't teetering on the edge of ruin. It's just operating a very specific model of wealth distribution.
Exactly. The wealth is warehoused in the people, and the government borrows it to function.
Okay, let's follow the actual money, though, because here is where the plumbing gets really opaque.
Sure.
The private sector, the lemonade stand kids, has all this wealth from exporting goods to the rest of the world. Let's say a major manufacturer in one of these surplus countries sells $100 million worth of laptops to buyers in the United States.
Okay.
They get paid in U.S. dollars. But they can't pay the local electric bill for their factory or pay their assembly line workers with a corporate account full of U.S. dollars. The workers need the local currency to buy groceries.
Right.
So how does that foreign money actually enter the domestic economy and become usable wealth?
Well, this is where we enter the realm of central bank alchemy. Let's trace the exact path of that specific $100 million.
Lead the way.
The manufacturer receives the $100 million in U.S. dollars. As you noted, they need local currency. So they take that $100 million to their local commercial bank, just a regular, everyday corporate bank. They ask the commercial bank to exchange the dollars for local currency at whatever the current exchange rate is.
Right, so the commercial bank takes the dollars, puts them in their vault, and credits the manufacturer's account with the equivalent in local currency. Yeah. Now the workers get paid.
Yes. But zoom out for a second. If this is a massive export-driven country, it's not just one manufacturer doing this.
Oh, right.
It's thousands of them every single day. The commercial banks are suddenly getting flooded with billions and billions of U.S. dollars.
And a local commercial bank probably doesn't want to hold billions of U.S. dollars indefinitely.
Not all.
They need local currency to do their own business, issuing mortgages, making small business loans in their own country.
Exactly. They become overloaded with foreign currency. So they turn to the ultimate buyer in the financial system, the central bank.
Okay.
The commercial banks go to the central bank and say, we have an absolute mountain of U.S. dollars. We need to swap this for local currency. And the central bank agrees to buy them.
Hold on, let me play the auditor here.
Go for it.
When the central bank agrees to buy billions of U.S. dollars from the commercial banks, where do they get the local currency to pay for it?
That is the multi-billion-dollar question.
Do they just open a vault and take out local tax revenue? Why don't they just use the assets they already hold, like their gold reserves or existing government bonds, to trade for those dollars?
To understand why they don't use existing assets, you have to look at the sheer, terrifying scale of modern global trade.
Okay.
Central banks don't use gold because the volume of trade surpluses, often hundreds of billions of dollars annually for a single country, would drain their gold reserves in a matter of months, if not weeks.
Oh, wow.
Yeah. The global foreign exchange market trades trillions of dollars a day. It is a massive, continuous, raging river of incoming dollars, and gold is just a finite, static pond. It's a total mismatch of scale.
Okay, so gold is out. What about selling off domestic government bonds they hold to raise the local cash?
Well, think about the mechanics of the bond market. If the central bank suddenly tried to sell off billions of dollars worth of domestic government bonds every single month just to get the local currency to buy export dollars, they would utterly flood the bond market with supply.
And when you flood a market with supply, the price drops.
Yes. And in the bond market, there is an iron law. When bond prices drop, bond yields or interest rates spike. If the central bank crashed the bond market just to absorb export dollars, domestic interest rates would skyrocket. Mortgages would become unaffordable, corporate borrowing would freeze, and the central bank would instantly trigger a massive recession in their own country.
So they can't use gold and they can't sell bonds without destroying their own economy. So where does the local currency come from?
They literally type it into existence.
They're just invented.
Yes. When the central bank buys the $100 million from the commercial bank, they don't hand over existing cash. They just log into the commercial bank's reserve account at the central bank and add some zeros. They expand their balance sheet.
That sounds absolutely terrifying.
It does, yeah.
Isn't that just reckless money printing? I mean, we've all seen the historical photos from Zimbabwe or the Weimar Republic where people are taking wheelbarrows of cash to buy a loaf of bread because the central bank printed too much money. How is this any different?
Well, the visual of printing money is the same, but the underlying accounting is fundamentally different.
Okay.
It introduces a crucial concept from the sources called funds outstanding for foreign exchange.
Funds outstanding for foreign exchange.
Right. When a central bank in a hyperinflationary scenario like Weimar Germany prints money, they are printing it with absolutely nothing backing it, usually just to pay off insurmountable government debts. They are creating unbacked liability.
Just paper.
Just paper. But in our export scenario, every new local bill, every new digital zero created on that screen is backed by an equivalent U.S. dollar that is now physically or digitally locked in the central bank's vault.
So it's a one-to-one collateral system.
Mm-hmm. Exactly. It is a credit swap. The central bank is essentially broadcasting to the market, yes, we just created 1 billion units of new local currency, but don't panic. because that currency derives its underlying value from the hard U.S. dollars we just acquired and locked away.
Right.
The asset side of the central bank's balance sheet goes up because they hold more U.S. dollars. The liability side goes up because they printed more local currency. The books balance perfectly.
I see the accounting logic. But let's look at the real-world implications of this.
Okay.
If the central bank is forced to print massive amounts of new money constantly just to buy up all these export dollars, doesn't that inherently dilute the value of the money everyone else in the country is already holding?
Yeah.
Like if you suddenly double the amount of money floating around a monopoly board, every individual dollar is worth less. Aren't these massive exporters essentially forcing the central bank to dilute the wealth of their own citizens?
You've just hit on one of the most fascinating and arguably most unfair economic principles in existence. It's called the Cantillon effect.
The Cantillon effect. Where does that come from?
So Richard Cantillon was an 18th century economist and banker. He lived through the massive financial bubbles in France and noticed something profound about how money works.
What was it?
Well, we tend to think of inflation like water rising evenly in a bathtub. But Cantillon realized that new money doesn't magically appear in everyone's wallet at the exact same time. It enters the economy at a specific targeted point and then ripples outward.
Like dropping a rock into a pond.
Exactly. And the people standing closest to where the rock drops get a massive, distinct advantage.
Right.
In our scenario, who gets the freshly printed money first?
The exporters. The central bank gives the new money to the commercial banks, who credit the accounts of the manufacturers who just sold the laptops.
The exporters are first in line at the buffet. They get this brand new, freshly minted money before it has circulated into the broader economy.
Wow.
Which means they get to spend it before the prices of goods and services have had time to adjust to the fact that there is now more money in the system.
So they're buying things with the new, larger money supply. But the price tags are still reflecting the old, smaller money supply.
Precisely. They take this fresh money and immediately buy up land, hire labor, build new factories, and expand their operations, all at current pre-inflation prices.
But eventually that money moves.
It always does.
The factory owner pays the construction company to build the new factory. The construction workers take their wages and go to the grocery store.
Yes. And as that new money slowly circulates down the chain, the overall supply of money in the economy increases, which inevitably causes prices to rise. That's the inflation. More money chasing the same amount of goods.
So who are the losers in this Cantillon game?
The people furthest from the rock dropping into the pond.
Right.
By the time that newly printed money finally trickles down to the average citizen, the hourly wage earner, or worst of all, the retiree living on a fixed pension, the inflation has already arrived. The prices of rent, groceries, and medical care have gone up, but their income hasn't adjusted yet, or it never will.
That's brutal. It's essentially a stealth transfer of wealth.
It really is.
Inflation acts as an invisible tax on static savings, which subsidizes the dynamic production of the exporters.
Exactly.
So the grandmother who kept her savings in a low-yield bank account is secretly, unwittingly, paying for the exporter's new manufacturing plant.
It is a brutal reality of the system. The purchasing power is quietly siphoned from the static savers and handed to the dynamic exporters. And this completely explains corporate strategy in these massive surplus countries.
How so?
Well, exporters don't care if there is a 5% or even 10% inflation rate in the broader domestic economy because their profit margins on the global exports might be 30% or 40%. They are outrunning the inflation.
And they know better than to hold on to the local cash, right?
Oh, absolutely. They know the currency is being diluted. So as soon as they receive that newly printed local currency, they immediately convert paper into hard assets.
Real estate.
They go on massive real estate buying sprees. They buy machinery. Or, counterintuitively, they take on massive amounts of corporate debt to expand even faster.
Wait, taking on debt during a high inflation feels risky. Why do that?
Because inflation makes debt objectively cheaper to pay off.
Oh.
If you borrow $10 million today and inflation devalues the currency by 10% over the next few years, the real purchasing power of the $10 million you eventually pay back is actually less than what you borrowed. You are paying back the loan with cheaper, diluted money.
That makes total sense. So the system is entirely rigged to reward the entities generating the foreign cash and to punish anyone holding on to the local currency.
It is a macroeconomic machine designed for aggressive, relentless growth, but the exhaust fumes of that machine inflation are breathed in by the domestic consumer.
Man! But wait, I'm looking at my notes here, and there is a glaring logical contradiction in how this system plays out on the global stage. We just established that the central bank is flooding the domestic market with newly printed money to buy up all these export dollars.
Right.
Basic fundamental laws of supply and demand dictate that if you massively increase the supply of something like currency, its value should drop, it should depreciate.
That's the internal inflationary pressure we just covered, yes.
But the sources also clearly state that in these massive trade surplus countries, their currency actually appreciates on the global foreign exchange market. It gets stronger. How is that physically possible?
It does sound impossible.
How can a currency be getting printed into oblivion, causing internal inflation while simultaneously getting stronger and more valuable internationally?
It feels like a paradox, but it's a completely logical outcome when you realize you have to split your perspective into two different isolated coordinates: internal purchasing power and external purchasing power.
Okay, walk me through the split.
Internally, as we just discussed, the money supply is ballooning.
Yeah.
The central bank is printing local currency at a furious pace to absorb the export dollars. There's more local money floating around, chasing the same domestic goods. So internally, groceries get expensive, rent skyrockets, the currency is losing its internal purchasing power.
Right. My local paycheck buys fewer local apples.
Now, switch to the external coordinate. Look at the international foreign exchange market. The entire world wants to buy this country's highly competitive laptops, cars, and manufactured goods.
Yeah.
To buy those goods, foreign buyers eventually need to acquire the local currency to settle the trades. Or at the very least, the massive, relentless inflow of foreign dollars creates immense pressure that makes the local currency highly sought after as a global asset class.
So externally, there is massive, insatiable demand for the currency.
Exactly. And remember, the central bank is constantly trying to manage this delicate balance. They are printing local currency, but they never print quite enough to completely satisfy the massive global demand.
Why?
Because they hold back just enough to prevent the domestic economy from collapsing into total hyperinflation. So, because the global demand for the country's goods, and thus the demand for its currency, is violently outstripping the new supply the central bank is creating, the currency gets more expensive on the global market. It appreciates.
Okay, I think the best way to picture this is like a wildly popular theme park.
Let's hear it.
Inside the park, management keeps printing more and more park tokens to pay their vendors. Because there are so many tokens floating around inside the gates, a hot dog that used to cost 2 tokens now costs 5 tokens. That's your internal inflation. But because the roller coasters in this park are so globally famous, millions of people outside the gates are furiously bidding up the price of admission just to get their hands on those tokens so they can get in.
Exactly.
So to someone on the outside looking in, the token is incredibly valuable and getting more expensive. To a vendor on the inside just trying to buy a hot dog, the token feels increasingly worthless.
That captures the dynamic perfectly. Internal inflation paired with external appreciation. And this specific phenomenon has a name in economics. It's called the Balassa-Samuelson effect, named after the economists Bella Balassa and Paul Samuelson, who detailed it in the 1960s.
How does Balassa-Samuelson explain the mechanics of it?
It explains why rapidly growing export economies inevitably see their domestic cost of living skyrocket while their currency remains strong. It adds a crucial labor layer to your theme park analogy.
Okay, what's a labor layer?
It works like this. The export sector, the manufacturers building the laptops, experiences a massive boom in productivity and profitability. Because they are making so much money globally, they can afford to drastically raise the wages of their engineers and factory workers.
Makes sense. The export workers get rich.
But here is the friction point. Consider the workers in the domestic service sector, the people cutting hair, waiting tables, or cleaning houses. Their productivity hasn't changed at all. A haircut still takes 30 minutes. It doesn't matter how advanced the country's semiconductor exports get, you can't dramatically speed up a haircut.
Sure.
But because the factory workers across town are now making so much money, the local barbershop has to drastically raise its wages just to keep its barbers from quitting and going to work at the factory.
Ah, so the service sector has to compete with the export sector for the same labor pool.
Exactly. So the barbershop starts paying its workers significantly more, even though they aren't cutting hair any faster or generating any more real value per hour. How does the barbershop afford to double its wages without going bankrupt?
They double the price of a haircut. Boom, domestic inflation.
Yes. So booming export productivity forces wages up across the entire domestic economy, which drives up domestic service prices, resulting in a high domestic cost of living paired with a strong currency driven by the exports. That is the Balassa-Samuelson paradox in action.
It's a brilliant explanation, but it highlights an incredibly dangerous endgame.
How so?
Well, if this cycle continues indefinitely, exports boom, bringing in foreign cash, central bank prints money, domestic labor gets incredibly expensive, currency gets stronger, doesn't there come a point where the currency gets so strong and the domestic labor gets so expensive that the country's exports suddenly become too expensive for foreigners to buy?
Yeah, that is the cliff edge every surplus country faces.
The laptops that used to be a bargain on the global market are suddenly priced out by competitors in other countries. The export engine sputters, the factories close, and the economy hollows out. The notes refer to this as the Dutch disease. Where does that term come from?
It originates from the Netherlands in the late 1950s and 60s. They
Okay.
discovered a massive natural gas field in Groningen. Suddenly, they were exporting huge amounts of gas, bringing in massive foreign revenues. Their currency spiked in value.
And what happened to the rest of their economy?
Well, as a result of that currency spike, their traditional manufacturing exports, which were the backbone of their employment, became far too expensive on the global market and just collapsed. The resource boom effectively killed the rest of their economy.
Wow. So if you are a smart government today running a massive trade surplus, and you see this theme park dynamic happening, you see the Dutch disease looming on the horizon, how do you stop it? How do you prevent your own wild success from destroying you?
You have to build a dam, a massive macroeconomic hydroelectric dam.
A dam.
And this brings us all the way back to the start of our conversation. Governments build these dams to intercept the flood of foreign dollars before they can permanently warp the domestic market.
Oh,
This is the true, hidden, primary purpose of a sovereign wealth fund for a surplus country. It is not just a giant savings account for a rainy day. It is a vital, active macroeconomic shield.
okay. Let's outline exactly how this dam works. How do you intercept the flood without crashing the system?
It requires a highly coordinated operation between the central bank and the government's Treasury Department. The process is called sterilization because they are trying to sterilize the inflationary effects of the central bank's money printing.
Okay.
Here is the step-by-step sequence. Step 1. As we established, the central bank has printed all this local currency to buy the export dollars. The local economy is starting to flood with liquidity, and inflation is threatening to boil over.
Right. The water level in the domestic pool is rising dangerously fast.
Step 2. The government's Treasury Department steps in. They issue government bonds to their own citizens and domestic commercial banks.
Okay.
They are essentially broadcasting to the market, hey, we see you have all this extra local currency floating around from the export boom. Loan it to us, buy these bonds, and we'll pay you a nice, safe yield.
So the Treasury borrows the local currency right back from the private sector. It acts like a giant vacuum, soaking up the excess water from the pool.
Exactly. Now the Treasury is sitting on a massive pile of local currency. Step 3. The Treasury takes that local currency, walks over to the central bank, and uses it to buy the U.S. dollars that the central bank had locked in its vault.
Okay, let me track the accounting on that. The central bank gets the local currency back, and the Treasury now holds the U.S. dollars.
Yes. And step 4, the Treasury hands those U.S. dollars over to the Sovereign Wealth Fund. And here is the absolute genius part of the design. They legally mandate that the Sovereign Wealth Fund must invest those dollars outside the country.
They take the money and throw it over the fence.
Precisely. They are legally barred from investing it domestically because that would just push the liquidity right back into the local economy.
Oh, that's smart.
Instead, the SWF takes those billions of dollars and buys commercial real estate in London, tech stocks in Silicon Valley, or infrastructure projects in South America. If you look at Norway's government pension fund Global, which is built on their oil surplus, it is the largest SWF in the world, owning roughly 1.5% of all globally listed shares. And they have incredibly strict rules about how much of that money can ever be brought back into the Norwegian domestic economy in a given year.
Because bringing it back would trigger the inflation and currency appreciation they worked so hard to avoid.
Exactly.
So what is the ultimate result of this four-step sterilization dance?
Two critical things happen simultaneously. First, the excess local currency was soaked back up by the Treasury bonds, which curbs the Cantillon effect and stops domestic inflation. The water level in the pool drops back down to a safe level.
Okay.
Second, the massive pile of U.S. dollars was removed from the central bank's vault and shipped overseas into foreign investments, which removes the pressure from the foreign exchange market and prevents the local currency from appreciating too much. The flood was intercepted, sterilized, and weaponized as global financial power.
It is macroeconomic judo. They are using the momentum of the flood against itself to build an empire of foreign assets.
Exactly what it is.
Let me do a micro-level check here, though. I want to make sure I understand how an everyday person interacts with this massive machine. Say I live in one of these surplus countries. I'm a student, and I need to exchange $10,000 of my local currency for U.S. dollars because I'm going to study abroad in the States.
Okay.
When I walk into my commercial bank to do this, am I interacting with this giant dam system? Am I getting new money or old money?
That's a great clarifying question. On a micro level, when you walk into your local branch to exchange $10,000, you are getting existing currency from the commercial bank's own internal liquidity pool.
Right.
On any given day, the bank likely has another customer who just exchanged dollars for local currency, and they're essentially just matching your trade with theirs behind the scenes. So you're getting old money that was already sloshing around in the commercial system.
So my transaction is just a drop in the bucket. The central bank isn't firing up the printing press for my tuition money.
On the surface, no. But if we connect this to the bigger picture, you are a tiny component of the larger aggregate demand.
Okay.
If you and thousands of other students and hundreds of massive corporate importers all want U.S. dollars on the exact same day, the commercial bank's internal pool of dollars will rapidly run dry.
Right.
When the commercial banks run out, they have to go to the central bank to get more dollars. So if the whole system is running short, your tiny transaction, combined with everyone else's, ultimately forces the central bank to react.
I see.
You are a tiny gear, but you are absolutely connected to the massive printing press and the sovereign wealth fund dam.
Okay, this entire system we've described, the export boom, the central bank alchemy, the Cantillon effect, the SWF dam, this is all predicated on the assumption that the country is winning, that the trade surplus is intact, and the foreign money is endlessly flowing in. What happens if the flow violently reverses? What if there is a global crisis? Exports collapse, and suddenly everyone, the citizens, the foreign investors, the corporations, panics and wants U.S. dollars instead of the local currency.
Oh man, that is the ultimate nightmare scenario for a central bank. You are describing a sudden stop, capital flight, and a massive trade deficit. And the mechanics of how a country defends itself in this scenario are just as fascinating, but far more brutal.
Let's explore the nightmare. What exactly happens during a bank run on dollars?
When confidence in the local economy evaporates, people rush to the exits. They all run to the commercial banks at the same time to trade their local currency for U.S. dollars. They want the safety of the global reserve currency.
Right. They want to get their wealth out of theme park tokens and back into hard cash before the theme park burns down.
Perfectly said. And the commercial banks quickly run out of their internal dollar reserves. Instantly. So the commercial banks run to the central bank, arms full of local currency, demanding dollars to satisfy their panicked customers.
The central bank is the final boss. They have to pay out.
Yes. And this is when the central bank has to dip into its precious foreign exchange reserves. These are the bullets it saved up in the vault during the good years. It takes the local currency back from the commercial banks, and it hands out the U.S. dollars.
Yeah.
Think of the 1997 Asian financial crisis. Thailand had pegged its currency, the baht, to the U.S. dollar. When speculators started attacking the baht, the Thai central bank had to constantly use its U.S. dollar reserves to buy up its own currency to maintain the value.
And did it work?
No. Eventually, they literally ran out of dollars, the peg broke, and the baht collapsed.
Okay, so the central bank gets all this local currency back in its vault as it hands out the dollars. Here's a highly practical, almost naive question from my end.
Yeah.
If the central bank gets billions in local currency handed back to them during a crisis, I read in the notes that they essentially destroy it. They extinguish it from the ledger.
They do.
Why do they do that? Why not just give that returned money to the government to build schools or fix roads or pay nurses to help soften the blow of the economic crisis? It's perfectly good money.
It feels like an immense waste, doesn't it? But this touches on the iron rule of accounting and central banking. Remember our earlier discussion about the central bank's balance sheet? The credit swap.
Right. Every local bill printed was backed by a locked-up U.S. dollar.
Exactly. If the central bank hands out a U.S. dollar from its reserves to a fleeing investor, the asset side of the central bank's balance sheet shrinks. Therefore, to keep the books balanced and maintain the integrity of the system, the liability side must also shrink.
Ah.
That means the local currency that was handed back to them must be extinguished. It must cease to exist on the ledger.
But what if they cheated? What if things are so bad domestically that the government quietly pressures the central bank to hand that returned local money over to the Treasury to spend?
If they do that, they break the fundamental asset-liability balance. Think about what happens in the real economy if they cheat.
Right.
The panicked investor who traded the money got a U.S. dollar and took it completely out of the country. So the U.S. dollar is gone. But if the central bank gives the local currency to the government spends it on infrastructure, and that local currency goes right back into domestic circulation.
Oh, I see the trap. The
Mhm.
local money is still out there circulating, but the hard U.S. dollar that was backing its value is gone?
Precisely. You now have the exact same amount of local currency circulating in the economy, but with significantly fewer U.S. dollars in the vault backing it up. It is an instant mathematical dilution of the currency's fundamental value.
It's macroeconomics fraud.
It is, and the global bond and currency markets will punish it instantly. Doing this turns a controlled, painful economic slowdown into an instant currency collapse.
Wow.
The moment investors realize the currency is no longer fully backed by foreign reserves, absolute panic ensues. The exchange rate plummets, the cost of importing crucial goods like energy and medicine skyrockets, and it is a direct one-way path to hyperinflation. We saw echoes of this in Argentina, where the central bank financed government deficits without the foreign reserves to back it up. This is why the strict discipline of destroying the return of currency is absolute.
Wow. It's like a casino. If a player goes to the cage and returns a $100 casino chip for cash, the casino can't just take that chip and give it to another player at the roulette table for free.
Right.
The chip has to be taken out of circulation, locked in a drawer, until someone buys it again with fresh cash.
Right.
If the casino just hands out returned chips, eventually people will try to cash out, the casino won't have the cash, and the casino goes bankrupt.
The casino analogy is perfect. The monetary base must shrink when foreign reserves shrink. It is incredibly painful. It causes severe recessions. It starves the domestic economy of liquidity, unemployment spikes. But it is the absolute only way to preserve the ultimate value of the currency and prevent total systemic collapse.
I am marveling at how strict, how unforgiving these rules are. If you don't have dollars to back your currency, you're doomed. You have to actively destroy your own money just to survive a crisis.
You do.
But wait, this applies to almost every country on Earth. What about the United States? The U.S. doesn't have foreign reserves backing the dollar. The dollar is the reserve.
True.
How does the Federal Reserve get away with printing trillions of dollars without this collateral? Are they just operating completely outside the laws of physics we just spent an hour establishing?
They're playing an entirely different game on an entirely different board. We have reached the very top of the global currency pyramid. What you are describing is a concept famously coined by a French finance minister in the 1960s as exorbitant privilege.
Exorbitant privilege. It sounds like an incredible luxury.
It is the ultimate financial superpower. The U.S. dollar is the undisputed apex predator of global finance. As you noted, the U.S. dollar isn't backed by foreign exchange in a vault. The Federal Reserve doesn't need to hoard euros or Japanese yen to justify printing dollars.
So what actually backs it? Why does anyone trust a dollar if there isn't another currency behind it?
It is backed by three incredibly powerful intertwined forces. First, the immense taxation power of the U.S. government over the world's largest, most dynamic economy.
Quite.
Second, the undeniable, overwhelming superiority of the U.S. military. And third, the structural design of global trade, specifically the petrodollar system established in the 1970s.
Right, which created a global requirement to buy oil and conduct most international trade in U.S. dollars.
Exactly, because everyone needs oil, everyone needs dollars.
Okay.
Because a country like Japan needs U.S. dollars to buy oil from Saudi Arabia, there is an infinite, insatiable global demand for the currency.
Okay, so when the Federal Reserve prints $1 trillion to stimulate the U.S. economy, how do they avoid the Cantillon effect and the hyperinflation that would completely destroy a normal country?
Because of that insatiable global demand, the inflation is exported. When the Fed prints $1 trillion, that money doesn't just stay trapped in Ohio or Florida, bidding up the price of local haircuts.
Where does it go?
It flows out immediately to buy manufactured goods from China, oil from the Middle East, cars from Germany. The newly printed money is rapidly absorbed by the entire global economy.
Wow.
The resulting inflationary pressure is diluted across the world's 7 billion people, rather than being concentrated solely on the 330 million people in the U.S.
That is staggering to think about. The U.S. government and the U.S. consumer get the immediate purchasing power of the new money, and the rest of the world absorbs a fraction of the inflation tax. That truly is an exorbitant privilege.
It is the foundation of American economic hegemony.
Is the U.S. the only one that can do this? What about Tier 2 of the pyramid? Are there other currencies that have a slice of this power?
Tier 2 belongs to major fiat currencies like the euro, the Japanese yen, and the British pound. They don't have the absolute global dominance of the dollar, but they have something very close.
How close?
Because of their massive, highly developed economies, deep and liquid government bond markets, and deep global trust in their central banking institutions, the European Central Bank and the Bank of Japan can back their currency with their own government debt.
Ah, so they don't need a vault full of U.S. dollars either.
Right. They can print euros or yen and hold their own sovereign bonds as the collateral. Global investors trust that the European and Japanese tax bases are robust enough and their political systems stable enough to honor those bonds, so the currency remains stable without a foreign anchor.
Okay, so the U.S. is the apex predator. Europe and Japan are Tier 2. What about Tier 3 and 4? What about the developing nations? The sources mention a very specific, almost theological term for them: original sin.
Yes. Original sin is a profound and somewhat tragic concept in international economics. It was coined by economists Barry Eichengreen and Ricardo Hausmann. It applies to many developing nations, primarily in parts of Africa, Southeast Asia, or Latin America.
What exactly is their original sin?
Their original sin is that the international financial markets simply do not trust them to borrow money in their own domestic currency.
Really?
Yeah. If a developing nation tries to run a deficit by printing money and backing it with its own government debt, the way Europe or Japan does, the global market will reject it outright. International investors will view it as worthless paper because they don't trust the long-term stability of the government, the strength of the institutions, or the country's ability to effectively collect taxes.
So they are completely banned from the magic trick that the U.S., Europe, and Japan use to fund themselves.
Exactly. They cannot self-finance on the global stage. Their local currency is essentially viewed by the international community as a local arcade token. It is only good for buying things within their own physical borders.
So how do they survive? How do they build infrastructure or buy essential imports like medicine?
They are forced to rely entirely on the brutal plumbing system we described earlier. They must run trade surpluses or attract foreign direct investment or take out loans denominated in U.S. dollars. They must acquire U.S. dollars and hold them in a vault to back every single local bill they print. If they don't, their currency collapses. This means they are completely tethered to the monetary policy of the United States. Well, when the U.S. Federal Reserve decides to raise interest rates to fight domestic U.S. inflation, it makes U.S. Treasury bonds very attractive.
Right.
Global capital flees these developing nations and rushes back to the United States, seeking those higher, safer yields.
Oh, wow.
This sudden capital flight sucks the dollars out of the developing nations, forcing their central banks into those brutal defensive measures we discussed, destroying their own currency, hiking their own interest rates to defend the peg, often resulting in severe, devastating economic recessions. They suffer the consequences of American monetary policy without any of the benefits.
That is a harsh reality. It's a completely tiered, almost feudal system. Let's bring this down to the highly practical level for you, because there is a crucial real-world application in the source material based on this original sin concept.
Right.
If you are ever offered a job working abroad in a developing nation, a country without a strong sovereign wealth fund or massive foreign exchange reserves, you need to be incredibly careful about your employment contract.
Yes, because in that scenario, the macro currency risk is being shifted entirely onto you.
The advice from the sources is clear. If you are working in an original sin economy, insist on being paid in U.S. dollars or another Tier 1 hard currency. If you accept a salary in the local arcade token, you are exposing yourself to massive, unpredictable macroeconomic forces.
Right. Imagine you take a job in an emerging market whose economy relies heavily on exporting a single commodity, like copper or oil.
Okay.
If there is a sudden global shock, say a recession in China causes the global demand for copper to plummet, That country's primary source of incoming U.S. dollars dries up overnight.
The nightmare scenario we just talked about. The
Mhm.
commercial banks run out of dollars, the central bank burns through its reserves.
Exactly. And when the central bank runs out of dollars to back their currency, they have no choice but to let the currency devalue aggressively against the dollar.
Wow.
Your salary, which might have been worth $5,000 a month in actual purchasing power yesterday, could suddenly be worth $2,000 a month overnight. You haven't taken a pay cut on paper. You're still making the same amount of local currency. But the macroeconomic plumbing system has violently drained your wealth.
It's terrifying how fast it can happen. It really shows how these massive, abstract concepts, central bank balance sheets, sovereign wealth funds, the Cantillon effect, they aren't just academic theories. They directly impact the food on your table, the cost of your mortgage, and the fundamental value of your labor.
We are all swimming in this plumbing system, whether we realize it or not. The currents are always moving beneath the surface.
Okay, let's zoom out and summarize this incredible journey. We started by looking at the U.S. launching a sovereign wealth fund in 2025, breaking its traditional reliance on market fundamentalism.
Right.
That tension led us into the macroeconomic paradox of how a government can be deeply in debt while its private sector is flush with export cash, operating on the principle that the wealth is simply warehoused in the citizens.
And we saw how the government taps that wealth by issuing bonds against the massive pool of domestic savings.
Right. Then we followed the actual path of the export dollar, watching the central bank perform alchemy by typing local currency into existence, backed by foreign dollars, to absorb the massive inflow of cash.
Yeah.
We explored the inherent unfairness of the Cantillon effect, where exporters get the new money first, acting as an invisible tax on the static savings of the rest of the population.
And we unpacked the Balassa-Samuelson paradox, explaining the mechanics of why a country can experience massive domestic inflation, like the barbershop having to double its prices while its currency actually gets stronger internationally because of the relentless demand for its exports.
Then we looked at how smart governments avoid the Dutch disease by building the dam system, how sovereign wealth funds act as essential pressure valves, using treasury bonds to soak up excess local currency and shipping the U.S. dollars overseas to prevent domestic economic explosions.
Right. And we also looked at the dark side, the bank runs, and why central banks are forced to literally destroy their own money, like casino chips, to survive a capital flight and avoid macroeconomic fraud.
And finally, we looked at the global currency pyramid, the exorbitant privilege of the U.S. dollar sitting at the absolute apex, exporting its inflation to the rest of the globe, all the way down to the original sin of developing nations, whose local currencies are entirely at the mercy of global dollar flows.
It is a breathtaking, intricate system. It truly dictates the rules of the game for every single nation on Earth.
But before we wrap up, we want to leave you with a final provocative thought, something to chew on that goes beyond the current mechanics we've unpacked today.
Yeah, we've established that this entire global plumbing system, this massive interlocking architecture, relies on one central premise: the U.S. dollar acting as the ultimate, unquestioned anchor for everyone else's money. Every other currency, especially in the developing world, is essentially measuring its worth against the pile of dollars in the vault. But look at what is quietly happening on the fringes of global finance today.
What's that?
Well, with the rise of alternative payment networks, the experimentation with central bank digital currencies, and a renewed, aggressive global rush by central banks to hoard physical gold instead of U.S. treasuries, it raises a profound, almost existential question.
Okay.
Are we currently watching the slow, quiet, deliberate dismantling of this currency pyramid?
If the anchor breaks, what happens to the ships?
Exactly. If trust in the apex predator wanes, or if surplus countries simply refuse to hold U.S. dollars anymore, the entire plumbing system won't just leak. It will have to be violently re-engineered from the ground up.
That is a fascinating and somewhat terrifying thought to leave on. Thank you so much for joining us on this deep dive. The next time you look at the economic news or hear a politician talking about trade deficits, or even just pull a bill out of your own wallet, we hope you see it through this new multi-layered lens. Remember that simple rain barrel we talked about at the beginning?
It's gone.
It's gone. You're looking at the pipes now.
Until next time.